Arjuna Mahindran, Head of Asia Investment, HSBC Private Bank, as well joins us from Singapore. Arjuna, hi, morning. Liquidity coming into markets as European situation is sort of less risky. Fear of the banking crisis also has become much less. Inflation in emerging markets also has been on the downtrend. What is your call on equities from here onwards? And more importantly, now that China and India are beginning to relax their tight monetary stance, what implications could it have on emerging market fund flows?
Definitely, the relaxing of monetary policy in India and China will have a very profound effect on the Indian and Chinese equity markets and all risk asset markets, including eventually the property sectors, though that may take some time. The Indian stock market, I think, will definitely benefit from foreign fund flows because inflation is coming down fairly rapidly. But of course, we are also mindful of the fact that the inflationary numbers can be distorted to some extent by the fact that the statistical base effects, that's the high inflation last year, has created a high base, and therefore the numbers this year look fairly muted in comparison. Once that statistical effect has been erased, which would happen around the middle of the year, then I think inflationary pressure would still continue to be one of continuing concern. So I think for the time being, inflation in the emerging markets is on a downswing. That's primarily because there's been a significant increase in supply of agricultural products, particularly in the agricultural growing sectors around the world, in response to those high food prices which triggered off the inflationary surge late in 2010. That surge in prices has now resulted in higher production, and therefore food prices are on the way down unequivocally across the globe, and as a consequence we see inflation coming off in the short term. However, we'll have to watch this space because there's a chance that it could resurge later in the year, and that then could raise further concerns. But for the time being, I think for the next 6 months at least, this inflation dragon has been slain.
What is your sense? Because investors have been concerned regarding government's policy paralysis all of last year. Do you think the Indian government will try to reverse that in the upcoming budget, or do you think the budget is going to turn out to be a non-event of sorts?
Well, we already see some measures being implemented by the Indian government, we hope in the next few days, where they will unload some significant stakes, equity stakes in some of the public sector utilities and enterprises, we hope. That would be a very clear signal, I think, to the markets that the government is obviously trying to live up to its promises of divesting significant stakes in government-owned enterprises, etc. And that would then improve the cash position of the government immeasurably, which is one of the major concerns of investors abroad. But looking forward, I suppose the real challenge for India is to bring the big fiscal deficit under some form of control. And the only realistic way of doing that from a sustainable perspective is to somehow avoid tax exemptions, broaden the tax net, improve compliance, etc. And those are the clues that we are looking for in the budget in terms of setting the government budget on a sustainable basis, and of course trying to cut some of the wasteful expenditure which currently goes on subsidies and other types of handouts, which perhaps are not strictly necessary in a country that is growing at well over 7%.
Let's look at the macro driver. India's GDP estimates have been revised on the downside, and with the Jan IP number also below estimates. Do you think it's too early to make an assumption that Indian economy has generally revived?
It's very unlikely that the Indian economy would slow down significantly below 7% rates of growth, given that there's already some residual momentum from the previous bouts of government expenditure that were mounted last year and the year before. But on top of that, I think a big flow of capital into the equity market and into the risk asset markets would also engender more confidence, which then becomes a virtuous circle of improved confidence and improved investment, etc. So I think that should keep growth fairly well bid, if you like. And going forward, I really can't see significant downside to the economy, because emerging markets historically have always responded well to positive capital inflows. And really, I think the residual concern right now for investors is one of governance. If the government can get some of these issues related to development and its policies of divestment and allowing more space for the private sector to thrive in India, which is not a very difficult thing to achieve, and hopefully things will be announced in the budget which will live up to that maxim, then I think we should be able to see significant progress for the Indian economy.